Hello and welcome to another episode of Darwin Investors. Today we're going to be talking about the 20-for-1 Amazon stock split. Now I'm wearing my math hat, which means we're going to have to do some math today, and we're going to arrive a price that we think that Amazon's eventually going to get to after the split. So let me go ahead and share my screen and we'll get right into this. Right after this picture. I saw this picture here and I thought this was really interesting. This is a recent picture of Putin having a meeting with some of his people here, right? And you can see he's a good distance away from them. Now, one of the things I think is really interesting about this picture is go ahead and look where their hands are. If you're at the table, your hands have to be here, here, there, there, there. And if you're standing, there. If you move your hands, this guy will shoot you. Does that seem like the type of guy that wants to do nuclear war because he's looking to die? No, this guy does not want to die. He doesn't want to let them close because he's afraid they'll poison him, and he wants to see their hands because he doesn't want them to do anything to him. This guy is not about to nuke anybody. That's just my opinion. So let's go ahead and get into the Amazon stock split here. So Amazon's going to split. So when is it going to split? So it's got a 20-for-1 split, which means that if you own one share of Amazon, it's going to be worth 1/20th the price after the stock split. So you'll own 20 of those after the stock split. So according to SEC filings, shareholders will actually need to approve the stock split first. They will have a chance to vote on it during an annual meeting on May 25th, 2022. If all goes well, there will be a few other key days to watch. The first will be May 27th, which will serve as the record date. That means if you want to participate in the stock split, you must own Amazon stock by May 27th. Individual accounts will start to update to reflect the stock split by June 3rd. Finally, Amazon will start trading on what is called a split-adjusted basis by June 6, 2022. So why would Amazon want to split their stock? Well, here's the reason. We're talking about a stock that hasn't moved in price since July of 2020. And it hasn't moved in price despite all of the retail investor interest because it's $2,936 a share. And since it's that expensive, that means big banks and hedge funds are all that owns this stock. And since they're the ones that own this stock, they're not comfortable paying price to earnings ratios that are higher than say 20. So they're going to keep this thing range bound here until this price to earnings ratio is roughly 20. It's currently trading at 45. So they're going to want this PE ratio around 20 before you ever start to see this stock go up again. So where does this stock historically trade? Well, it historically trades around, we'll go with 75. Now we can see right now it's trading at 45. This is the PE ratio for Amazon. And we can see that right now it's trading cheaper basically than ever since it's been a profitable company. At the March 2020 low, it was trading at 72. So it's trading about what, 2/3 the price it was at the March 2020 pandemic low. I think what they're thinking is that if it was to split and retail investors would be able to get a hold of it, it would trade at a more reasonable price for this company of 72. So we'll call it even 75. I think 75 is being fair. So all of our numbers today, we're going to base it on a price to earnings ratio trailing 12 months of 75. So when we look at Amazon here, look at the growth this has. It did 117 billion in 2017, 232 billion, 280 billion, 386 billion, then 469 billion. This company, for a company this large, is growing its revenue at an alarming rate. Let's go with, like 20% a year, maybe more in certain years. But for a company this size, it's growing at a huge rate. The reason why the earnings per share or the PE ratio is low is because the company does not generate very much profit. A lot of the profit comes from Amazon Web Services, but it looks like this thing only has an operating margin of somewhere in the order of 5%. It's gone from 4 billion to 12 billion to 14 billion to 22 to 24 billion. And so they're only making 24 billion on $469 billion in revenue. And when you compare that to something else, like a stock that everybody hates at the moment, let's say Facebook, which would be a similar company, it's part of the FANG and all that. We're talking about a company that has 1/4 the total revenue of Amazon at 117 billion, but it generates double the net income of Amazon. So it makes 1/4 the revenue and double the net income of Amazon. And so why does Amazon just spend so much money? Why are they like so fiscally irresponsible? Well, it might have had a little bit, so it certainly has to do with like expanding and getting, opening up more warehouses and what they call CapEx or capital expenditures. But it might also have something to do with this guy here, this Jeff Bezos. We're talking about a guy that goes and builds a yacht in Netherlands. And now the yacht is too big to get under a bridge, so they have to dismantle it to get it through there. We're talking about a guy who wants to go into space. And when you hear someone else is going to space, he needs to be the first billionaire into space. And his biggest complaint is his spacesuit doesn't fit his crotch. Okay, we're talking about a guy that no one has been this irresponsible with money since maybe MC Hammer in 1987. And so enter this new guy here, Andy Jassy. So now we have a new CEO. Maybe this guy is going to be able to get this spending under control. My feeling is that he will. Now, what does having a bigger net margin have to do with the price of Amazon? Well, let me go ahead and show you. The way that you get a price to earnings ratio, it's the stock price divided by the earnings per share. So if we look at Amazon today, it went up a lot today. It went up $150. So we'll say that 29.36 minus 150 is about 27.86. So if you take 27.86, and that would have been the price it was at the beginning of the day when Schwab put these numbers up, and you divide that number by $64.71, you're going to get something about 43.05 or 43.04, like what they have here. So that's how you get a price to earnings ratio. It's share price divided by earnings per share. The earnings per share are made when you take the shares outstanding, which is $508 million, and you divide it by the net income, which we already told you is not as good as it could be, which is only $24 billion. Now let's say that Andy Jassy comes in here and then he's able to increase this instead of the 5% to 10%. And 10% would be nothing for a company like Amazon. Then this would be 48 billion, right? Which basically would mean that their price to earnings ratio immediately from right here today would be slashed in half or be about 21.5. Just by having an operating margin of 10% and watching how you spend money. And we're talking about a company that makes more money than like anybody else. Here it is, the revenue, $469 billion. Let's look at Apple. Apple's a huge company. I think we can all agree. Does Apple make 469 billion? It's probably close, but it probably isn't 469. So Apple makes 365 billion. What about Microsoft? As we can agree, Microsoft's a pretty big company. Does Microsoft make anywhere near 469 billion? Microsoft makes 168 billion. So they make almost like a fourth of Amazon. Amazon's that big. How did Amazon get so big? Well, Amazon is not just big in America, but let's take a look where they stand in the world. Top 10 e-commerce sites in Japan. Number 1, Amazon Japan. How about the top e-commerce sites in China. 17 best e-commerce sites to buy cheap and high quality goods in China. Well, we got AliExpress, which would be Alibaba, JD, Tmall, Pinduoduo, but down here at number 9 is Amazon China. How about top ones in Korea? Well, Amazon's teamed up with 11th Street in Korea, and 11th Street is the second biggest e-commerce site in Korea. 11th Street is number 2, and they're teamed up. Number 1 is Gmarket, number 2 is 11th Street, number 3 is auction.co, and finally number 5 down here is Coupang. One thing I think is interesting about the biggest sites in China, Amazon China comes in at 9. And here I think this is very interesting, is that Alibaba doesn't show up until 14. And that's one that I think, Charlie Munger's really big on it, and a lot of people are big on it. It's nowhere near the top e-commerce site in China. However, AliExpress is number 2. How about Europe? Well, top 10 online stores in Europe, number 1 is Amazon. How about Latin America? Top online marketplaces in Latin America. Well, number 1 is Mercado Libre, and then number 2 is Amazon. They've taken over the world, or they're taking over the world. How about top website rankings in Russia for e-commerce? Let's see, they're not in there. This whole crisis doesn't affect them. They're nothing to do with Russia. How about top e-commerce sites in Africa? Are they in there? Do they have the chance to grow to Africa? Well, number 1 is Jumia. Number 2 is Takealot. And number 3 is Kill 'Em All. You got to like the sites Takealot and Kill 'Em All. But no, Amazon's not in here yet. They can get into the African e-commerce market if they so choose. So there is a place for even them to expand. But I think more than expansion for them, the biggest thing for them is going to be just reeling in the costs, figuring out a way to grow your profit margin from 5% to 10%. But even at this price, let's go ahead and calculate what is a good, reasonable price for Amazon today. So, like I said, 75 seems reasonable for a price to earnings ratio of this stock. In 2019, Amazon was trading at about $1,300 a share. Why would the stock split matter? Why would we be able to drive the price up? Well, if you go and try and trade an option on Amazon right now, let's say I want to buy a call on Amazon that expires. When you buy a call, you want to send it out into the money. You don't want to have it expire soon. So let's make sure it's like July 15th. And let's say, and when you buy a call, you want to make sure it's in the money. It doesn't have to be that far in the money, 2780, but that's where the start of the day. But let's go with 2900, right? For a call, one single call on Amazon, slightly in the money, that expires July 15th, would cost you $27,465. This contract gives you control of 100 shares of Amazon. Nobody can afford that. Like, you can't have that and the rest of your portfolio too. If the only thing you can do is trade Amazon, this is what's keeping Amazon down, is this contract price, because it's not people buying 1 share, 2 shares of Amazon that makes the price go up and down. It's the people trading contracts, trading 100 shares of Amazon at a time, that make this price go up and down. Now, if you look at Amazon and their current share price, and remember, they're undergoing a 20-for-1 split, and you divide their current share price by 20, you're going to get $146.80. Let's look for a stock that trades for $146.80 and see what their options trade for. Right off the top of my head, I'm thinking maybe Airbnb trades at roughly that price. ABNB. Let's go with a call. Airbnb, same thing, July 15th. Slightly in the money. We'll even put it further in $145. So instead of paying $27,000 for a call, you're paying $2,432. That's still not cheap. This is a very volatile stock. As a matter of fact, all options are going to be very expensive now because the market is incredibly volatile, which is why it's good to sell options at this moment, by the way, and not buy them. If you don't understand volatility, probably shouldn't be messing with options. But in a highly volatile market, you want to sell, you don't want to buy. Now, in this highly volatile market, we got a very highly volatile stock. And so this was trading for $2,432. But it's not $27,000. So retail investors might be able to choke this down, but we're not going to be able to trade 100 shares of Amazon at $27,000. What do others think of the current price of Amazon stock? Well, here's the Morningstar research team, and these guys are incredibly conservative. So they have a fair value estimate of the stock of 4,100. So if we figure out what they believe a price to earnings ratio that's fair right now for Amazon, they're looking at 4,100 divided by 64.71, and they believe that a fair price to earnings is 63. Now, I think it's higher. I think it's 75. But even then, they're giving this stock 4,100 divided by 29.63. They're still saying this stock has 38% upside from here, and these guys are very conservative. Let's take a quick look at some of their analysis. I always like to look at the bear case and the bull case of stocks. Now, they're maintaining a wide moat for Amazon at $4,100 per share. Obviously, they have that. You can see they're the top of pretty much every market in the world, excluding Russia. If you look at their bull case here, Amazon is the clear leader in e-commerce and enjoys unrivaled scale to continue to invest in growth opportunities and drive the very best customer service. High margin advertising and Amazon Web Services are growing faster than the corporate average. The Amazon Web Services are still bigger than Microsoft Azure. They're bigger than Google Cloud. Amazon Web Services is what gives them the operating margin that they have. It's a fantastic cloud server. And that will continue to boost profitability over the next several years. Amazon Prime membership helps attract and retain customers who spend more with Amazon and reinforces a powerful network effect while bringing in recurring and high margin revenue. And they just lifted the price on Amazon Prime. So and they seem to have pricing power on that because they're the main e-commerce player in the world. I guess we're going to have to pay that because we're always ordering. And if we have to pay $140 versus $113, we'll do it. All right, so the bears say that regulatory concerns are rising for large tech firms, including Amazon. They are also saying that new investments, notably in fulfillment, delivery, and Amazon Web Service, should dampen free cash flow growth. As we said, they do squander money, and they're saying that, look, building all these warehouses and getting all these new Rivian electric vehicles to do last mile delivery, this is all going to cost a lot of money. Amazon may not be as successful in penetrating new retail categories such as luxury goods due to consumer preference and improved e-commerce experience from large retailers. It is true. Amazon does seem to be running into a problem, at least in my view, with certain things. Like if I want to order, say, a table or something, I don't immediately go to Amazon. I might go to Wayfair. If I want to order, say, a stereo equipment or something like that, rather than going to Amazon, I might go directly to Best Buy or something like that. So there are a lot more e-commerce players that are coming online now, and up into including Costco, although their experience is, I understand, not that great. But what I'm saying is that a lot more different companies are getting into the e-commerce platform, which could eventually cut into Amazon's market share. And that'd be another reason why they may want to reel in some of these costs today before other players basically start catching up to them, at least in certain markets. So let's go ahead and figure out what I believe is a fair market price for Amazon today. So what I said is I believe that Amazon, based on this here, should trade roughly 75 times. Morningstar said they believed it should trade at roughly 63 times. But at 75 times, 75 times 64, 71.71 equals $4,853 a share. Morningstar said 4,100. Like I said, they're very conservative. Even their conservative rating, though, is really, really good. So if you divide this by 2963, you've got a 63% increase in their share price from after the stock split, which was in June. So we're going to get quite a boost in price in the next 3 months. I'm still going to be more on the side of Google in this. I love the valuation of Google. I have more. I don't say I have more faith that it'll go up. I don't think it'll go up as much as Amazon. Even like if you really want to throw the dice, I think Amazon could be your play here. If you look at what the share price is now on this versus what I believe it will be, 29.36 or 36 divided by 20, the current share price would be $146.80, but it was like 48 something, 48.53 divided by 20, $242 or something like that. So we're talking about another $100 a share over this. So every share of Amazon, I suspect you should make about $2,000. That's a pretty dang nice return. Although I'm very conservative, and I understand that every share of Google will get you about 1,000, and every share of this one will get you about 2,000. But because of this price to earnings ratio, and because there's some ifs involved, it's if other people don't infringe on Amazon's territory, if they're able to increase their operating margins, if retail investors are able to boost this to a price to earnings ratio of 75 in a market that really doesn't care for that sort of thing right now. There's a lot of ifs involved in this Amazon stock price. For all those reasons, I'm a bigger fan of Google than I am of Amazon at this split, but it doesn't mean I won't buy Amazon. I'm going to have a little piece of this. I can't help it. Just in case. What if it does go up double what Google does? I'm like, dang it, I should have had it. But that's my take on this. I believe that Amazon could go up to about $240, $250 a share. I think we can all picture that really easily, and after the split. And so that's what I'm going to be doing. I'll probably buy a little bit, not as much as Google, just because I'm not much of a risk taker as that's concerned. If you got anything out of this video, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye.